David Brickell, Director of Sales at Paradigm. Welcome to The Big Picture. In this series, we're going to be taking a look at the world of crypto through a big picture macro lens. So what are the big stories in macro? What are the key developments? And what does that mean for crypto? So let's jump straight into that. So it's been a pretty pivotal couple of weeks in the world of macro. The key headline story, literally the headline story, being that in the Wall Street Journal from the so-called Fed mouthpiece, Nick Timiraos. And what Nick said in the article was that whilst the Fed are expected to hike this week by 75 basis points and will do just that, the big conversation that's going to be had this week will be about slowing down the pace of hikes going forward. And quite importantly, how they're going to communicate that to the market. Now, this isn't a pivot. This isn't even a pause, but what matters for markets is generally the direction of travel and particularly rates of change. And it's quite clear that we're now reaching a point where we're coming to the end of this aggressive hike cycle that's killed all asset classes throughout the last year. We've seen, certainly in terms of the pace of hikes, start to slow. We've already seen that with the RBA, the Reserve Bank Australia. We saw last week with the Bank of Canada, who hiked 50 instead of the 75 basis points that markets were expecting. And we even saw, I guess, a slightly more dovish ECB press conference where they were a little bit softer on their forward guidance. And what's driving that? I think the main thing that's driving this is now a concern starting to shift a little bit away from inflation, which does remain uncomfortably high and it is pretty sticky. But we're kind of starting to shift a little bit of focus away from that and back towards this sharp growth slowdown that we're seeing globally and in domestic economies. Just last week in the US, we saw PMIs, manufacturing PMIs and service sector PMIs fall quite sharply and show those sectors being in contraction territory. We even saw house prices plunge the fastest level since 2009. So it's quite clear that the slowdown in the activity data from this hiking cycle and from this pace of financial tightening is starting to bite quite severely. Policymakers are just starting to take note of that. We've even seen some of the Fed big hitters in Brainard and Daly. They're starting just to talk a little bit more about the lagged impacts of monetary policy and also warn on the risks of over-tightening. So the market's just starting to pick this up, that we're actually about to just start to change pace a little bit, and perhaps we're reaching the end of that hike cycle. And certainly we've started to see what we call the terminal rate, the final sort of endpoint of where we think this hike cycle ends. Markets are just starting to reprice that a little bit. That's just allowed risk to breathe a little bit easier. However, there's a potentially bigger story that's bubbling under the surface and I think is potentially quite key to why we saw the risk rally we had last week. And I think it's potentially a game changer for the sort of macro dynamic that's been driving markets up to this point. And that is the story that Janet Yellen, Treasury Secretary, has been consulting with the primary dealer banks. Now, these primary dealers are the banks that are approved to buy government bonds directly from the government. And she's been speaking to them about the liquidity in the treasury market and the stability in that market. According to Bloomberg, liquidity is at its worst levels since March 2020, when we were in the depths of the COVID blow up. So there's a concern about liquidity in that market. Certainly we've seen the likes of the Bank of Japan who are engaged in yield curve control. We saw the Bank of England have to step in and support their gilt market, which at one point looked like that was going to become quite disorderly. And Janet Yellen and the Treasury are growing increasingly concerned about liquidity in their own market. The Treasury market is the benchmark market that all asset classes are priced off. And if that starts to blow up, then that's a game changer. Now, the way a potential Treasury buyback would work is they would issue bonds at the front end of the curve. So essentially T-bills. And they'd use the cash receipts from that to then buy bonds further out the curve. So that will look and feel very much like yield curve control. And as we've seen, be it through the Bank of Japan or when the Bank of England were forced to intervene in their markets, yield curve control tends to lead to a weaker currency, which is perhaps a little bit convenient in terms of timing, given that the so-called dollar wrecking ball is really starting to suffocate global growth, and we're starting to see some major asset markets really start to look like they're about to break. Since we started to have this story, which I say is bubbling under the surface, we've seen the dollar come off quite sharply from its highs. What's particularly interesting and important about this as well is the point on liquidity. Liquidity is fundamental to our markets, and crypto short term still remains a high beta risk asset. And high beta risk assets are very dependent on liquidity. And the reason we've seen crypto, the reason we've seen the Nasdaq and tech stocks get hit so hard this year, as well as broad assets, because of this withdrawal of liquidity. So liquidity has been tightened through a function of the strong dollar, through higher interest rates with central banks hiking rates. We've seen money supply growth collapse, and we've also seen central banks pursue quantitative tightening, so withdrawing the liquidity that they pumped into the system during the COVID crisis. Liquidity is the be-all and end-all to these markets, and that liquidity tap has been firmly turned off. However, with this potential Treasury buyback program, what this means and why this is so important, it's potentially turning the liquidity hose back on. And here's how this process works, and bear with me because this gets quite technical. The Federal Reserve, they have a reserve repo facility. Now what this facility is designed for is it's a facility whereby banks and money market funds can park cash with them overnight. They do that to put a base in yields. Banks and money market funds typically invest and park their cash in short-dated, highly rated instruments, usually T-bills. And if we just, for simplicity, stick with T-bills. So they'll park that money into T-bills so they know they can easily access that liquidity when they need. If the demand for those T-bills outstrips the supply, then you start to see yields in those T-bills fall. So if the yields are falling lower, then that becomes counter to what the Fed are trying to do in terms of raising rates. So consequently, they'll provide an alternative through their reserve repo facility where effectively you can park cash and achieve a higher rate than what would be going in the T-bill market. Money market funds and banks could then earn bigger returns by parking their money at the Fed. Now, with this potential Treasury buyback program, what will be happening is you'll see the Treasury issue more T-bills. Now, the importance of this is this will start to draw the money out of the reserve repo. Now, just for context, there's over $2 trillion worth of cash parked overnight, just sat there at the Fed. And what potentially this program does of Treasury buybacks is starts to tease that money out of the reserve repo facility and back into markets. So what effectively will happen is the Treasury are taking that money to fund the T-bill issuance and then using that cash to then buy bonds further down the curve as part of the buyback program. So you start to push this liquidity coming back into the market from reserve repos. You're pushing that liquidity back into the bond market further along the curve, and you start to push people, this kind of flow of liquidity starts to push investors further out the risk curve. Now, that looks and feels very much like quantitative easing. And indeed, the impacts will be very similar to what we've seen in QE. So it's a potentially game changer for markets that have been starved of liquidity. The potential for a Treasury buyback program all of a sudden starts to turn back that fire hose of liquidity, which should start to see high beta risk assets perform and starts to see crypto perform even more so given its high beta correlation. So it's not certain yet. There's still lots to go in terms of how that program is going to play out. But markets that are over positioned for this lack of liquidity, over positioned for the aggressive tightening that we're seeing, are just starting to be given a few reasons to think that A, we're coming to the end of the tightening cycle, and B, we might start to see through the Treasury buyback program liquidity switch back on. And that's a game changer in terms of, particularly given how we're positioned in markets, and it's a complete shift in the macro narrative and macro trend that has driven markets lower so far this year. And I think it potentially signifies a bottom in the market, and we could start to see the beginnings of a new bull market, both for crypto and wider risk assets. So we're keeping an eye on it. There's still plenty to play out within that, but we'll keep you updated here and we'll see how that develops.